$130 billion. That is what American banks collected in credit card interest and fees in 2025. Not revenue from loans, not profit from investments, not money earned from any product or service that made your life better. $130 billion extracted, quietly, automatically, from people who thought they were using a financial tool and were actually inside one. To put that number in scale, $130 billion is more than the GDP of Hungary. It is more than what the U.S. government spends on education annually. It is more than the combined annual revenue of Nike, Starbucks, and McDonald's. And it came almost entirely from people who thought they were being responsible. Not from the reckless, not from the financially illiterate, from people who pay their bills, who check their statements, who consider themselves reasonably careful with money. That's the first thing you need to understand about the credit card industry. It was not designed to trap irresponsible people. It was designed to trap you. Here is how the machine was built. Bank of America mails 60,000 unsolicited credit cards to residents of Fresno, California. No application, no credit check, just an envelope with a card inside and a $500 limit and a letter explaining how to use it. They called it the Bank AmeriCard. You know it today as Visa. The early losses were catastrophic. Fraud, defaults, chaos. Bank of America lost millions in the first year. Internally, executives called it the Fresno Drop and considered it a failure. But people kept using the cards. And the people who carried a balance, who didn't pay it off at the end of the month, generated something the bank had never seen before. A recurring, compounding, nearly automatic revenue stream that required almost no additional work to maintain. The product wasn't broken, it was early. By 1970, every major bank in America was issuing cards. By 1980, the infrastructure was national. By 2000, it was embedded in the architecture of daily life so completely that opting out meant paying more for plane tickets, getting turned away at car rental counters, and explaining yourself at hotel front desks. By 2026, there are 1.1 billion credit cards in circulation in the United States. One country, 1.1 billion cards. The Fresno Drop worked. Now, here is how the money actually moves, because most people understand that interest is how banks make money. What most people don't understand is the specific engineering underneath it. The average credit card APR in May 2026 is 24.8%. Not 8%, not 12%, 24.8%. For context, the federal funds rate, the rate at which banks borrow money from the government, is 4.33%. Banks are borrowing at 4.33% and lending to you at 24.8%. The spread is 20 percentage points. On every dollar you carry as a balance, the bank earns 20 cents a year in pure margin after their own borrowing cost. At scale, on $1.14 trillion in outstanding revolving credit card debt, which is what Americans collectively owe right now, in May 2026, a record high? That spread generates roughly $228 billion in gross interest income annually. That number is so large it becomes abstract. So make it personal. The average American household carrying a credit card balance owes $10,479. At 24.8% APR, that household pays $2,599 in interest per year, $216 a month, every month, for carrying a balance that never fully goes away because the minimum payment is designed not to clear it. That $216 doesn't buy anything. It doesn't reduce the principal meaningfully. It is the rent you pay to owe money to an institution that borrowed that money for a fraction of what they're charging you. But Interest is only the beginning, because the credit card industry has a second revenue engine that most people never think about: interchange fees. Every time you swipe a credit card, every single transaction, whether you pay it off in full or not, the merchant pays a fee, typically 1.5% to 3.5% of the transaction amount. That fee goes to the bank that issued your card. You bought a $60 dinner, the restaurant paid $1.80 to your bank, you bought $200 in groceries. The grocery store paid $6 to your bank. You bought a $1,200 flight. The airline paid $36 to your bank. In 2025, interchange fees generated $72 billion for card issuers. Combined with interest, over $200 billion in annual revenue from credit cards alone, the $130 billion figure is conservative. And here's the part that makes it elegant from the bank's perspective. The people who cost the bank nothing, the ones who pay their balance in full every month, who take the rewards and pay no interest, are subsidized by the people who carry balances. The rewards points you earn for paying in full are funded by the 49% of cardholders who don't. The responsible users get the points. The struggling users pay for them. The bank collects from everyone. Now, here is the psychological architecture, because none of this works without it. The minimum payment. This is the single most quietly destructive number on your statement. Banks are legally required to show you the minimum payment due. They are not required to make you understand what paying only the minimum actually means. So here's what it actually means. You have $5,000 on a card at 24.8% APR. Your minimum payment this month is $100. If you pay only the minimum every month, adjusting as the balance falls, it takes you 7 years and 4 months to pay off that $5,000. Total interest paid, $4,823. You borrowed $5,000. You paid back $9,823. The bank almost doubled its money on a credit card. That you applied for voluntarily. That you used to buy groceries and gas and things you needed. Since 2022, banks are required to show you a minimum payment warning on statements. A box that says how long it takes and how much it costs to pay only the minimum. That box exists because consumer advocates fought for it. It is in small print. It is below the minimum payment line. It is designed to be complied with, not noticed. Then there are the fees, because interest isn't enough. Late payment fee, up to $41, triggered if your payment arrives even 1 day late. Cash advance fee, 5% of the transaction or $10, whichever is higher. Plus a separate higher APR that starts accruing immediately with no grace period. Balance transfer fee, 3% to 5%. The thing they advertise as a solution to your debt, costs money to use. Foreign transaction fee, 3%. You travel, you buy coffee in another country, the bank takes 3%. Annual fee, $95 to $695 depending on the card. The premium cards charge you for the privilege of giving them more interchange revenue every time you swipe. Over-limit fee, technically illegal now to charge automatically. So banks instead decline your transaction and charge you nothing, unless you opt into over-limit protection, which lets the transaction go through and charges you $25 to $35 for the convenience. In 2025, late fees alone generated $14 billion. One fee, $14 billion. From people who were 1 day late. Here's the part nobody talks about when they hand you a card with a sign-up bonus. The sign-up bonus is math, not generosity. A card offers you 60,000 points, worth roughly $600 in travel, if you spend $4,000 in the first 3 months. The bank's calculation: a new cardholder who hits a sign-up bonus has demonstrated the spending behavior of someone who will carry a balance. The acquisition cost of $600 in points is recovered, on average, within 7 months of account opening through interchange fees alone. If the cardholder carries a balance for even 2 months, which 49% do, it's recovered faster. The bonus isn't a gift. It's a customer acquisition cost that pays for itself automatically. You are not being rewarded for signing up. You are being onboarded. So what do you actually do with all of this? 3 things: specific, practical, immediately applicable. First, pay the full statement balance, not the minimum, not a round number. The full statement balance every single month by the due date. This one behavior eliminates 100% of your interest charges. You use the card, you take the rewards. The bank gets interchange, you pay 0 interest. You have exited the primary revenue model entirely. Second, treat a cash advance like a medical emergency. Never, under any circumstance, use a credit card for a cash advance unless the alternative is genuinely catastrophic. The fee plus the immediate compounding interest at a higher rate makes it one of the most expensive ways to borrow money available to a consumer in 2026. Third, set up autopay for the full statement balance, not the minimum, the full balance. Do it today. It takes 4 minutes. It removes the human error that generates $14 billion in late fees every year. The banks are counting on you to forget. Autopay makes forgetting impossible. $130 billion. That number doesn't come from villains. It doesn't require fraud or deception. It comes from a system so carefully engineered, so deeply embedded in daily life, so fluent in human psychology, that opting out feels harder than staying in. Somewhere tonight, a 31-year-old is looking at a credit card statement. The minimum payment is $95. The balance is $6,200. She pays $95. The bank just made another month's worth of $130 billion. The machine is running. It runs every month on autopilot, yours or the bank's. You get to decide whose.